Hello, everyone. How are you? It's welcome to Capital Advantage Tutoring's live Q&A. Ginger, how are you? Okay, Ginger, you finally answered a question. I love it. Okay. So on the 66, well, we have to figure out the cap M. So do you know what cap M is? That's my grandson. Okay. So on the 6, cap M is all about are we getting enough? Tyler, that's awesome. Wendy? Whoa. Look at you. Wendy nailing it. Tyler doing it. Oh, good news. That's awesome. Okay. Everyone, that's awesome. So now, cap M is always about are we getting enough reward and risk and all that stuff. So you don't need to know the math. You need to know the concept. That's so Ginger, remember something. On the 66, you do not need to know the math. You know, oh yeah, when Judy has a bunch of questions I'm going to knit. You have to know the concept. You have to know modern portfolio theory, cap M, future value, Sharpe ratio. You have to know the concepts and why someone would do it and why someone wouldn't. That's the key. Awesome. Okay. Tyler, so are you done? Tyler, are you totally done? Other than life and health? Look, here's the thing with life and health. Each state has their own rules, so that causes a problem. So each state does their own thing on this. So what happens is that, yeah, I help people with the basics, but for the most part, it's more just, okay. Yes, Colleen, look at that. Peter, I can do that one for you a second. Okay. So actually, I did a video on that, but I'll talk about it again. Okay. So you're pretty much done other than life and health, right? That's awesome. JP Morgan, that's a great firm. That's awesome. Okay. Now, he might be getting me more views if he comes on. Okay, so now. Okay, so what's intrinsic value? Okay. And then, Judy, I'm going to start working through your stuff. Okay. Okay, Drew, hold on. Okay. The 90-day back to at first I was like, what are you talking about? Then I figured out. Okay. So first of all, intrinsic value. Okay. There you go. Ginger, there you go. Colleen is awesome at this. She's super, super helpful. Also, Colleen, and if Rachel comes on, I have someone who has their SIE and he's taking the 6. I don't know if you guys are hiring. He'll be willing to take the 7. Let me know. Okay. So So Peter, let's talk about this. Intrinsic. Intrinsic is what we call the in the money amount. Guys, remember, one question after I answer it, then you don't do so I'm gonna have this guy Jason reach out to you. And I'll talk to you. I don't know where he's located. I don't know if you guys are only in where you are. Okay. Now. Yeah, Colleen, if you want to do is if you guys don't want to give, if you're going to put your email out, guys, everyone find Colleen on LinkedIn. That's the easiest way. This way she doesn't put her email on here. You don't need to do that. Find her out, Colleen Lyons on LinkedIn. She's great. She has a lot of good posts. Reach out to her that way. That's the best way. And she gets a connection. Back to this. So, Peter, I think you mean discounted cash flow. I don't think you mean cash flow discount. Okay, so now you have to. So intrinsic is what they call the in the money amount. Okay. So the in the money amount is intrinsic. So if you have a 50 call, you have the right to buy stock at 50. Doesn't matter, buy or sell, it doesn't matter. If the stock's trading at 53, it's $3 in the money or $3 of intrinsic. So intrinsic is how much in the money the option is. It has nothing to do with buy or sell. It has nothing to do with premium. So if you have a call, anything above the strike price is intrinsic. So if you have a 50 call, it's trading at 58, $8 of intrinsic. If it's trading at 54, $4 of intrinsic. 62, 12. 48, 0. 32, 0. So anything below the strike price on a call is no in the money or no intrinsic, and anything above it has intrinsic or it's in the money. The put is the opposite. Remember, premium doesn't matter, buy sell doesn't matter. Anything below the strike price is in the money. So if you have a 40 strike price on a put, anything below the 40 is the intrinsic. So if it's trading at 38, you have 2. If it's trading at 36, you have 4. If it's trading at 30, you have 10. If it's trading at 40, you have 0. No intrinsic. Peter, hope that helps. Discount. I'm going to get Judy's stuff up in a second. I snoozed it so it'll come back up around now. Where are we? Judy asks really long questions. I love her for it, right? She's driving me crazy. Here we go. Snooze 12 hours ago. So it pop up. Okay. Oh, it's in a dock. That's how big it is. That's how scary it is. So, Tyler, again, I'm so happy for you. The good thing is getting the life and health done. It's awesome. Okay. Okay, Drew, I'll get to you in 1 second. So, Peter, the other thing is discounted cash flow. Really what you're doing is you're taking all the future cash flows that you're getting in, whether it's a bond or a company or even stocks, the dividends, and you're discounting them all back for inflation. So you're taking all the future cash flows. Like, let's say you're getting a bond and you're getting $100 a year. That $100 a year is $100 this year. But next year, that 100 really only buys like $99 worth of stuff. So it's only worth 99, and then 98, then 97. So they're discounting all the future cash flows to come up with a present value today, what the bond should be worth. And if you can buy it for less than that, then you have a positive NPV. And if you buy it more than that, you have a negative NPV. Hope that helps a little bit, Peter. Again, if you're taking the 7, it's probably not a heavy deal. 66, that'll definitely show up. Oh, my glasses are over there. Okay. So, Drew, since you're taking it tomorrow, the best thing you do is make sure you watch the suitability video. Make sure you watch the How to Pass the Series 6 and 7 video. Sleep is underrated. Okay, I can't say this enough. Do not spend all night cramming. The other thing is, if you have Kaplan, go through their facts. If you have STC, go through their crunch time facts. If you have Notman, go through their class summary. Any one of those 3, those things are super helpful. But again, really make sure that you're focused on watching the suitability video I have and the How to Pass the Series 6. Make sure you're good at margin because it's only a couple questions, but why give it up? And get sleep. That's the biggest thing I can say, Drew. I mean, the night before, the best thing to do is get a lot of sleep. Okay, Matt. So so we know what a mutual fund is. So Judy, I am going to get to your stuff. I got to find my glasses. But Judy, a letter of intent. Yes. I get to put on my broken glasses so I can read. Look at that. Okay. I keep breaking them. I mean, I have like 30 pair all over the place. I have good ones with me. So, letter of intent. So if you want to put money, so mutual funds, the big thing is about getting break points, right? So the big thing about mutual funds is getting break points with their volume discounts. Normally you have to put the money in, but they allow for what they call a letter of intent. A letter of intent is saying, hey, listen, I'm going to put in $5,000, but I promise I'm going to put another, 30 or 40 grand in over the next 13 months. So they'll give you the break point based on that total amount, which is great. You're actually allowed to use, if you put money in like 2 months ago or 3 months ago, you can go backdate it at as much as 90 days to use that money. So say you put in $5,000 now and you go, wait, I put in $2,000 2 months ago. Can I include that in the letter of intent? And you can. So that's all it is. It's not a big deal. You're just backdating you're backdating the signage, I guess, to cover money you put up to 90 days ago. But here's the thing. The max letter of intent is 13 months. So if you go back 90 days, you can only go forward 10 months. Okay. Somebody else has a question on retirement. Okay. The retirement accounts, look, really, I don't think I even did a video on them. I probably should. But remember, this is what you have to remember. So retirement accounts are this, and this is quick and dirty because you're taking it tomorrow. Retirement accounts that are qualified means it's pre-tax, which means when you take the money out, you pay tax on everything. The earliest you can take it out without a penalty is 59.5. The latest you can take it out without a penalty, start taking it out at 72. April 1st after you turn 72. That's qualified. And you pay tax on every penny when you take it out. It's called pre-tax. When you put it in, gross tax deferred. Non-qualified means you put the money in after tax, which means you've been taxed on it. Yet it's still gross tax deferred, just like that. So it grows tax deferred, and then when you take it out, you only pay tax on the growth portion. And some of them don't have an RMD, that 72-year-old required thing. But a lot of them still have the rule that you can't take the money out until you're 59 and a half. So defined contribution means you know what's going in, but you don't know what it's going to be when you're older. So it's better for younger people. They take advantage of growth. Defined benefit is you don't know what you're putting in, but you know what you're going to get. Like I have a friend who's an iron worker. They tell him for every year that you work, we're going to pay you $200 a month. So they're telling him what he'll get at the end. He has no idea, doesn't give a shit what they're going to put in from now, but he knows his benefit is going to be that way in the future. Both of those are some sort of qualified plan. Qualified plan usually means pre-tax. You can't discriminate, which means you have to offer it to everyone who's full-time and over 21. And it's pre-tax, gross tax deferred. You pay tax on everything on the way out. On the other side, we have non-qualified, which is like either not sponsored by a corporation or the money goes in after tax, gross tax deferred, and then you only pay tax on the growth. Okay, so let's hit one of Judy's. Okay. Hold on. Boom. It's easier on my screen, I think. Where is Judy? Judy, where are you? Where are you? There we are. With her massive doc that she screws me over with. Okay. If it is determined that a security must be registered prior to its sale in the state, section, who cares about sections? Okay. First one, nobody cares who files it. Everyone gets that stupid question wrong. So, Judy, the question here is saying who files it. Nobody cares. Basically, the issuer or anyone backing the issuer can register security. So again, this is for the 63/66. Any security being registered can be registered by anyone involved in the thing, whether it's the issuer or somebody or the broker-dealer or somebody doing it on their behalf. Highly doubt you ever get a question that detailed. Whose questions are these? I wonder who they are. They don't look familiar. Which of the following individuals would most likely be willing to sell securities? I'll slow it down. Which of the following individuals would be most likely to be willing to sell securities for the benefit of the issuer without receiving any compensation? A registered broker-dealer? No, because a broker-dealer wants commission. A salaried individual working for a broker-dealer? No, they want to get paid. Investment advisor rep? No, they want to get paid. So a member of the issuer's board of directors. I hope how many questions? Okay. So basically, again, these are not great questions. I do not like these at all because they don't make sense. That these are not questions that you would be asked. So which of the following individuals would be most likely to be willing to sell securities for the benefit of the issuer without compensation? Obviously, be a member of the board of directors or an owner because then they'll get money on the back end. Rising Tide Investments, a broker-dealer specializing in underwriting new issues, was a lead underwriter for the recent IPO of XYZ. When publishing a favorable research report about the stock, the broker-dealer will go ahead and release the reach. You don't have to wait 6 months. You don't have to wait for approval from an issuer. You don't have to wait for the administrator to do a report. Remember, no regulator ever approves anything ever. So this is saying that I did an underwriter. I was a lead underwriter of a stock at one point. I want to do a research report. I can do it, but I have to disclose a conflict of interest that if I do a research report, I have to list that I was an underwriter for that company. A broker-dealer is a member of the underwriting syndicate for a new issue of common stock. From all indications, it appears that the offering will be oversubscribed, which means, so guys, oversubscribed means that if we're going to issue 100,000 shares, it means that goes to 110, 130, 140,000 shares are subscribed, which means people want those shares. So it means more people want it. Okay. Okay, again, stupid question. They're saying allocate the shares of the issuer to clients in a manner that is based on their indication of willingness. Really, if it's oversubscribed, everyone gets a portion. So again, if we have 1 million shares we're issuing and 2 million get asked for, everyone should probably get 50% of what they want. That's kind of the way they do it. You have to be fair to everyone. You can't give it to the largest clients. You can't give it to the employees and the clients the same. And you can't withhold. You can't hold it back. Okay. I don't like any of these questions. Okay. In which of the following situations is an agent most likely to be in violation? An agent acting on behalf of clients purchases shares in an oversubscribed IPO. That's fine. An agent suggests a client with a short-term financial need borrow from his margin account, held at the broker-dealer. Yes, that's fine, because that's what they're there for. You can borrow the SMA to pay off some short-term needs. The agent's and registers in several states where he has no clients. That's okay. Maybe you think you're going to get clients. A customer instructs an agent to purchase shares of ABC. A company the agent knows is experiencing financial difficulty. The agent purchases a stock purchases a different stock. I got it. So if you're told by your client to buy shares, even if it's horrible, you try to hook them out of it, but you can't not do it. You have to do it. Even if you would save them millions of dollars, you can still get in trouble. So when a client tells you to buy something, you have to buy it. You can try to talk them out of it, but if he or she won't change your mind, you have to do it. Under the Uniform Securities Act, the definition of a sale, exercising a right. So if you exercise a right to buy shares or convert, if you're paying money, then it would be a sale. Because remember, an offer is the attempt, the sale is a transaction. Okay. Now, the last thing, can I please confirm that STC was correct in stating that individuals who represent an issuer in the sale of a federal covered security are not required? Yes. So here's the deal. If you work for an issuer and you see the work, not the broker dealer, you work for the issuer, then you pay your salary. If it's either an exempt security, which is federally covered, or an exempt transaction, the person doesn't have to register if they're not getting a commission. Okay. Judy, I got through all of them. Not bad. Okay. Matt, I hope that helped with the 90-day letter of intent thing. Papers all over the place. Okay, now. Okay. 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 I'm catching up. Matt, how are you? Okay. Yep. Paul, yeah, I agree, Sandy. Call up, put down. Are those videos helping you, Sandy? I'm just wondering. I can't tell sometimes. Okay. Boom, Colleen. That'll work. I'll have you because you can help. Okay. Just for Jen, I'm trying not to say okay all the time. Perfect. That's true. Intrinsic value plus time value equals premium. Either one of them can be zero. Matt, how are you? Okay. Tax treatment of income payments for variable annuities versus withdrawal payment. Okay. Johnny, so now, anytime you take money out of an account, it's going to be taxable. If it's a variable annuity, it's a qualified annuity, which they have to say that the entire amount you get will be taxed as ordinary income. If it's a non-qualified annuity, then the payments you get you'll either have to do it on a LIFO basis. If you withdraw from a variable annuity versus the annuity payment, they're going to take the money out and they're going to tax it on a LIFO basis, which means the growth comes out first, which is taxable, and the principal comes out last, which is not taxable. If it's a non-qualified. If it's qualified, every penny gets taxed at ordinary income. Remember, anytime you see retirement account or deferred, always think ordinary income. It's not going to be capital gains. Now, when you take money out of a mutual fund, well, I think they can do average price if you want. So that when you take the money out, it depends on your cost basis and the growth. So you could have, if it's anything above your cost basis, you will owe taxes on. I can look up and see if there's a specific thing. Okay. I'll check to see if there's a special thing on the payment plan, but really you're going to pay taxes on everything that's above your cost basis. But I'll see if they handle it different. But I do think that you can average out your cost basis and then anything you pay for over that. But there's no tax breaks on this shit. So on an income for a variable annuity, the only tax break you get is the fact that you don't pay taxes until you take it out. So it's deferred. Hopefully you're at a lower rate. Okay. Don't worry about fair market value. That's not a thing that you're going to hear. Matt, you should buy the Series 6 stuff from the STC people. I got the link, baby. Okay. Buy it from there. It's probably, I think it's the best, and it's not super, super difficult. If you pass the SIE, you shouldn't have a problem with the 6. Judy, when I have 10,000 people, we're almost there. Okay. I'm over a third of the way there. Amortization. So Peter, amortization, I think I just did a thing on this, but amortization is when you buy a bond at a premium. So let's say we buy a bond for $1,200. and it's 10 years to maturity. So that means it's $200 over par, and it's 10 years to maturity. So what you're going to do is you're going to take the $200, divide it by 10 years, and then you're going to depreciate. It sounds like it. So you're going to lower the cost basis by that amount by that. So if it's $200 over par, 10 years to maturity, 200 divided by 10, that's $20 a year that you're taking off your cost basis, but you don't get a tax break on it. So that's why it's not like depreciation, but it sounds just like it. So Peter, you're absolutely right. So amortization is when you're taking you're taking a premium bond and discounting it back. Yes, so you're reducing it by that premium amount every year. By the way, the rule is only muni premiums have to amortize. And on the discount side, it's accreting, which is sort of the same thing. Only OIDs, another word for OID is a zero coupon. Only OIDs must accrete. Okay. Boom. Okay. How are dividends from ADRs taxed? Okay. So what happens is usually if a dividend, well, sometimes the ADRs will come out, the foreign corporation will take their portion of it first, and then you get paid, say. Anything you pay in taxes to the foreign corporation, this is where the question is. Anything you get paid from the foreign corporation will be a tax credit on what you owe here. So let's say you get $1,000 dividend. Woo, big stuff. And you pay $200, or say you pay $800 in taxes to London, say. When you come here, say you owe $1,000 in taxes to the US, they will say, oh, but you paid $200, you paid $800 to London, only owe us $200. So they will, whatever you pay to the foreign country, they will reduce what you owe here. That's a tax credit or tax deduction. Other than that, ADRs, any money you get will be taxed at ordinary income. Okay? But if you hold it for long enough, you should get, I don't know if they do the qualified dividend. That's a great question. The ADRs, I'll double check to see if ADRs get the qualified dividend. But for the most part, they all tax at ordinary income. Okay. Jessica Milstein, why is the Cmo taxed on every level? Everything. You don't need to know why, but everything. Okay? Everything is taxed on every level. There are only 7 things that don't. Remember this. So it's really 2 things, but I spread it out, make it sound better. Bills, notes, bonds, tips, and strips pay federal, not tax. I'll say it again. Bills, notes, bonds, tips, and strips, those are treasuries, pay federal, not state. Boom. On the other side, GOs and munis pay state, not federal, and they may not even have to pay state if it's in your own state. Those 7 things, okay? Other than that, you pay tax on every level. Yeah, Sally Mae's in there, but I don't care. Other than those 7 things, you will pay tax on every level on everything. Because remember, even Ginnie Mae's you're paying taxes on. CMOs you're paying taxes on every level, state, federal, and local. Okay. Drew, you better. I'll be on Thursday. Come on down and tell me. Okay. That's interesting. So the easy financial calculator, that's good to do it. Too bad, but the problem is, so the easy financial calculator in the App Store, does it do it for you or does it explain it? Okay. Okay. Yeah, Kaplan, those questions are super deep, Judy. Okay. Okay, good. Yeah, so Justin, that's awesome. You got that. I don't know how to make you remember formulas for that. Just, you got to read them. Watch my quick and dirty thing on the 66. That should help. Somebody just texted me today saying that it really helped them. I was like, awesome. Okay, statutory disqualification. That's when you really screw up, okay? So statutory disqualification means that FINRA will blanketly not allow you to register. Like if you look, in reality, if you come in there and you have a crime from 15 years ago, the chances of getting hired are pretty slim. But if you do, they can do that. But if you have, this is what happens. So FINRA has rules. If you are found guilty, if you have a guilty plea or you're guilty or convicted of any felony in the last 10 years, you cannot work. Boom. Okay. If you are convicted, like guilty, whatever it is, found guilty of any securities or ethics or monetary misdemeanor in the last 10 years, you can't work. There are appeals available. Like if you think you can get in there and a company wants to back you, they can appeal it. It's going to cost them money every year, but they can appeal it. But for the most part, you can't work. You have to wait for the 10 years. If you are found to be guilty of violating federal laws or commodities laws, or in the last 10 years, you cannot work. If it's more than 10 years, you still have to disclose it, but they can't use it. The firm may not hire you, but FINRA cannot deny you because of that if it's more than 10 years ago. Hope that helps, Georgiana. Okay. Okay. Okay, Ottoman slap thinks he can get through, but it's all, look at that Ottoman slap. I am just gonna disappear because Ottoman slap is held in saying some nasty stuff. Boom. Ottoman slap. This is all we do. We just delete. That's all we have to do. It's awesome. Watch this. Put him in timeout. There we go. Hide him. He now can't do anything. I love the filter. It doesn't let people who curse on here come on here. And you guys don't get to see what this person was saying, which is pretty horrible. Okay. Okay, Matt. Yield, so they call it yield to worst. So when we quote a muni bond, it's always quoted yield to worst. So if you have a discount bond, it goes coupon, current, yield to maturity, yield to call. So you're always going to quote the coupon. You're always going to quote the yield to maturity on a discount bond. Always. So coupon, current, yield to maturity, yield to call. So you're always going to quote the worst of them. So you're going to quote yield to maturity. That's what they mean by that. That when you quote it and you offer the price to someone and you tell them on the confirm what they got, you give them yield to maturity if it's a discount, and if it's a premium, coupon, current, yield to maturity, yield to call. Yield to call is the lowest. So in a premium, you're going to quote yield to call because it's the worst. You're trying to give them the worst possible yield so that, and you're trying to give them the worst case scenario, so hopefully it's better. Like when you quote a mutual fund, you quote the max POP because then anything they do will be better. Okay. That's a great question. So, Johnny, if you hold a bond to maturity, you have no capital gain or loss. If you hold the bond to maturity, you have no capital gain or loss. It's just income. You're paying income every year. Remember, you're paying income every year, so it's accreting up to maturity. Well, hope that helps. Yeah, I agree, Justin. You need to memorize the formulas. Start watching that video. Just write what you do. Just write them down. Just write each thing down. Go future value. What an investment now will be worth in the future. Present value. What I need to invest to get that number. CAPM. Risk versus reward. Just write them down in one sentence on a card and just try to do it that way. Ottoman is a busy man. Okay. Okay. '24. I don't have any videos yet. That's tough. Okay. I did not do it. Yeah. Okay. Hold on. Gone too far. It's pretty funny. So now, did anyone see Ottoman saying stuff? I don't know if it was held up. I don't know if you guys saw it. Okay. So now. So Dylan, yeah, I don't have any videos on the 24, but make sure you get down. I don't know what books you're using. Make sure you get down the whole broker-dealer stuff. Get down the workings of the broker-dealers, what's right. And as my students say on the 24, they said basically it's your register up screws up and how do you handle it? And 24 is definitely, you have to read. But I'm going to say one thing, don't sweat the net cap. The net cap, all the different numbers and the haircuts and stuff, barely on the exam. The books love it, okay? Books love this stuff, but to go into it, but the actual test doesn't. Yeah. So here, Colleen, that's real world versus test world, right? So unless they bring up that it's in an IRA, then it's a whole different story, right? But we try to answer. We don't put real world into this. Yes, you could put a mutual fund in an IRA and then or a Roth, and then you pay no taxes. But that's the whole point here is that we're working on not. They answer the question in front of you. Don't put your own stuff in. So you have enough knowledge that you're learning the deeper end of it, which almost hurts you a little bit on the exam. Okay. 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 Can I explain the Form ADVs? Okay. So let me do one thing. So if a broker-dealer, when a broker-dealer registers, they use Form BD and they file it with FINRA. Boom. It lists all the owners and affiliates and conflicts and all that stuff. Form ADV is for the advisor. So the investment advisor registers with either the SEC or the state. So ADV Part 1 is the facts, who the owners are, how many branches we have, how much money we have, who we're registered with, all that stuff, just the facts. That's Part 1. That doesn't actually have to be given to the clients. That is it's going to be filed with either the SEC or the administrator. Part 2, there's 2 parts, 2A and 2B. Part 2A is the disclosure doc, also known as the brochure. It lists like the conflicts of interest. It lists like the owners, their backgrounds, the partners, how we manage money, how we do fees, all the disclosures. If we have affiliates, if we have conflicts of interest. But 2A is disclosures for the firm. So let's say, Justin, you're working on, the Park Avenue team. 2B will be a disclosure doc for the Park Avenue team alone. So you have to give 2A and 2B. It's also called the supplemental. So 2B is going to have like your background, your history, your conflicts, your manager's one, all that stuff, how you guys do the fee, what strategy you use, whether you have custody or not, if you have conflicts, if you charge different fees to different people. So remember, part 1 is the facts. Part 2 is the disclosures. That's called the brochure, or called the ADV Part 2, disclosure doc or brochure. That must be given to the client under the SEC at or prior to them signing the contract. Under the USA, 48 hours before they sign the contract, or they have 5 days to back out of it. Okay. Cameron, when NAV? Okay. Alicia, I'll get to you in a second. Okay. Dylan, that's awesome. I appreciate it. There you go. I like that. But no, 2A is firm, 2B is team. I don't know what 2C is, and then 2A is for E is for custody, like with the auditor. Okay, so hold on a second. Cameron. Oh, I hope I get stuck in here. I hate when I do my crystal light. Okay. NAV is what. So NAV is what the fund is worth per share. So you buy it at NAV plus a sales charge. So you buy it at the POP. Unless, of course, you have a breakpoint, then it's NAV plus the lower sales charge. So NAV, if you don't really buy at NAV, you can sell or redeem at NAV, which means no charge. But you buy it unless it's a no load, or a back end, there's going to be some sort of sales charge that add to it. So Class A will be NAV plus a sales charge up to 8.5%. And a B will be a NAV plus maybe a sales charge when you leave, maybe called a redemption fee. But if you stay for more than 5 years, they won't charge anything. Class C is like a level load, and you're going to pay a 12B1 fee every year. So if you buy, in general, without going to nuances, when you buy at the POP, which is NAV plus a sales charge, and you sell at the NAV, and they calculate it when? Forward pricing. So if I buy it at 10 in the afternoon, and you buy at 2 p.m., we're going to get the same price. Cameron, find my How to Pass the Series 6 video. It says How to Pass the Series 6 and 7. It's a whole 45 minutes on mutual funds and about 10, 15 minutes on annuities, because that's all they really deserve. Okay. So Alicia, don't sweat the options on this test. You could get a couple of them. Okay. Oh, Colleen, that's awesome. So that's great. So Justin, definitely take a look at that. I'll take a look at that too. Maybe I'll do a little thing where I show the screen. Okay. Now, so where are we? So Alicia, don't sweat the options too much. Seriously, you do need to understand them. Watch my one video on the options. And if you understand that, the one I have, I think it's chapter 9 or something like that on the SIE book thing, you'd be fine. I agree. A lot of the books go deep into the stuff that doesn't really work. Okay. So get the concepts, get the risks down. Okay. Oh, where'd the screen go? I didn't shut it down. That would suck. Okay. So focus on the risks, like their products and the risks for the SIE, Alicia. Get the options on, understand buy a call, buy a put, sell a call, sell a put. Understand this. If you're long stock, how do you hedge it? You buy a put to protect or sell a call for income. Write that down. Long stock, sell a call for income, buy a put for protection. If you're short stock, you buy a call for protection or sell a put for income. Buy a call, you're bullish, buy a put, you're bearish, sell a call, you're bearish because you're taking the other side of a buy call, and sell a put, you're bullish because you're taking the other side of the, okay. Yeah, I agree. That's awesome. Okay. Wow, that's awesome. I agree. The books are, the books I don't like very much. I agree. So my margin shit. So yeah. So if you like Dylan, I appreciate it. You're right. I do think the margin stuff is pretty simple, and you're talking 2 12-minute videos versus other people who do like an hour and a half videos on margin, which is just a waste. Okay. So Georgiana, no, 529s cannot be rolled over into IRAs. That's just a rule. They cannot do it. I just even double check to make sure. Okay. Okay. Right. So I do think most of the options is definitional. Okay. So thank you, Andy. So there's one more thing. So break even on an option. If it's buy a call or sell a call by itself, it's strike plus premium. On the put side, if it's a by itself, it's strike minus premium. If it's stock and an option, it's always stock plus or minus premium. So what you do is you look, if it's stock and you bought both or sold both, you're going to add to the stock price. So if it's the same, you add. And if it's a buy and a sell, like say you buy stock and buy a put, that's to add. You're going to add to the stock price, the premium. If it's buy stock and sell a call, you're going to subtract. So if they're the same, you add. If they're different, you subtract. Okay. Okay. Yeah, that's true. Mr. Desby, right? Exactly. Without the E. Okay. Sophia, TRF. Okay. 2 totally different things. TRF and ORF are for reporting. So on NASDAQ, if you're doing a trade on NASDAQ and it's not done through the system, it's done manually in a way, you're going to use TRF, Trade Reporting Facility. You have 10 seconds to report it, and it goes to ACT. If it's an over-the-counter security, use ORF, Over-the-Counter Reporting Facility, and that's how you report. OATS has nothing to do with that. OATS is like a digital nanny cam, as one of my guys all told me. It's watching the trade. It's like an order reporting. It's an audit trail where it takes the order from when you get it to when it's executed, so that you can see whether somebody backed away or front run or something like that. OATS is not about reporting. OATS is tracking the order from when you get it to when it's executed. TRF is after you do the trade, the reporting facility. ORF, over the counter. TRF is for NASDAQ. Guys, if you do like what I'm doing, please hit like. I love it. Okay. Now, again, I hope that helps Aisha a little bit. Okay. What's the most tested top on the SIE? There's not one. Really, if I had to pick one, I would go with risk. Okay. The risks of the various products. I would definitely try to go over the risks of the various products. I would go over the regs. If you have Achievable, the book. If you have STC, chapters 14 through 20 are massive on this exam because that's the regs, and then chapter 20 is a risk. That's assuming that you've done the first 9 chapters where you understand the products. You need to understand what common stock is, what preferred is. And Mike, I have those videos that run through the whole thing, okay? The whole STC book. And so now you have to know what common stock is. You have to know the difference between preferred and bonds and mutual funds. And you have to know why someone will buy them and the risks of buying them. And then you have to know the rules, like what to do to open an account. How do you open an options account? Remember, that's why I'm doing those little TikTok videos to help you out with little things. I'm doing the shorts, like what a preferred is, little things that you don't have to waste a lot of time watching. Opening an options account, Dado 15, disclosure, approval, trade, options agreement. Okay. Sorry. Okay. Dylan, Trace. Okay. Gregory, how are you? So now, let's talk about the order reporting. So this is for the 24 and the 57, if anyone's taking it. Okay. Okay. If you do a trade in a corporate security, corporate stock, you're going to report via TRF. If it's on NASDAQ, over the counter, it's ORF. We got that, and you have 10 seconds to report. If you do a trade in a corporate bond or a treasury bond, you use Trace, and you have 15 minutes to report it. I don't remember the hours. I think it's still 6:30. I can't remember the hours on that one. But it's not super important. But understand, Trace is like TRF, but for corporates and treasuries. Munis won't really be on the 24, but if you get the question, it's RTRS, which is the most basic thing ever, real-time reporting system. And again, bonds are always 15 minutes. Equities are always 10 seconds. And now on that ORF, remember, I think it's still 6:30. So if you don't report it by 6:30, you have to wait till the next morning to report it. Same thing with TRF and ORF. If you do a trade in between 8 a.m. and 8 p.m., you report it within 10 seconds. If it's 8 p.m. all the way till 8 a.m., you're going to report it by 8:15 the next morning. Looked it up still a little bit. Remember, Trace is a reporting thing. And TRACS, tracks, is more for ADF, which is not even a thing. Okay. A Ginnie Mae mutual fund, the only thing I can think of it is, it's as a mutual fund of mortgage-backed securities. That's all I can think of it. I've never actually heard of one, but it's the only thing I can think is that it's basically a mutual fund that holds Ginnie Mae securities. Let me just double check to make sure I'm not wrong. Okay. Yep. So it's basically a mutual fund that specializes in mortgage-backed securities. It primarily invests in Ginnie Mae securities, so there's not a lot of principal risk. That helps. Okay. Yeah, just let me know. Just go on my website, Dylan, go into my website, series7exam.org, and you can reach out to me. My schedule's on there. If you go to that website, you hit the book now button. I do all of them. That's what I do all day. And I teach 7 days a week. The only day I can't do, I think, is the 19th. But you'll be done by then. So just reach out, go on there. My schedule's on there. If you want to do it, just hit book now and you'll find it. So I'm not doing that to push these, but if you're going to ask, I have no problem. Okay. Alicia, I think I've done this. I think on one of the videos, but I'm not sure. So slobs over bliss, right? Slobs over bliss. So you place sell limits and buy stops above the last sale. Sell limits because it gets up there, and buy stops because if it gets up there, maybe you want to buy it. I've done order types, so find that. So you place sell limits and buy stops above the last sale. That's why I say slobs over bliss. Bliss, buy limits and sell stops are placed below the market. A buy limit, you want to buy it when it gets down lower, or a sell stop. Maybe the stock's going the wrong way and you just want to get out of it. So let's say the stock's trading at 50. You say sell 100 shares at 45 stop. We're all good until the stock trades at 45, and then you're not good. It'll trigger, and then it'll sell it as a market on the next trade, no matter what. So remember, bliss orders are below the market, slobs are above. That's where they're placed compared to the last sale. Now, also, buy limits and sell stops, which are below the market, are the only ones adjusted for stock splits and dividends. Okay. And I think I answered all Judy's stuff. I got the questions done. Dylan, if you want to reach out, do it. Greg, how are you? I love that. And I think we're good to go. Okay, guys, thank you very much. I get to go hang out with my grandson a little bit more before he cocks out. And everyone, thank you very much. And I'll see you on Thursday night. Have a good night.